What's going on, guys? It's David Osborne here, and today I wanted to make a quick video about financial literacy in 20 terms that every beginner should know. Today I've got Jimena Restrepo here. You should check her out on her channel. She talks a lot about Taiwan and traveling, and she is more or less a beginner when it comes to personal finance. How many personal finance books would you say you've read?
In their entirety?
Just how about at least half of the book?
At least half, none. I read Susie Orman. I read 75% of Susie Orman. Let's call it one tops.
Okay. In school, you didn't really take any personal finance classes?
No.
What we're gonna do is I'm gonna say the financial term, do a quick pause, and allow you to say the meaning out loud. Feel free to keep score, make a little tick on a piece of paper or something like that, and see how many you get right out of 20. So the first financial literacy term is debt.
That's hard. Okay, I guess debt is the amount of money that you owe an entity or an industry or or a person, someone that lent you money that you haven't paid back.
That's basically right. Debt is money that you owe to somebody or some entity out there. Number 2, assets.
I want to say assets are like investments that make money for you.
That's basically correct. The simple definition of an asset is anything that puts money into your pocket. An example, a job. Does it put money into your pocket?
Yes.
And it is an asset. How about a car? Does a car put money into your pocket? No, because you've got to pay for oil changes and gasoline and all that stuff. So a car is not an asset unless you are selling that car. Then obviously once you sell it, it puts money into your pocket. The third one on the list is liabilities.
I know that assets make you money. Liabilities take money. So I guess they would be investments that don't give you money, that require you to pay for them.
Okay, they don't have to be investments. A liability is just anything that costs you money.
Could that be your boyfriend?
He could be a liability, not me, but somebody else's boyfriend could be a liability. And that leads us into actually my next personal finance question, and that is expenses.
I would say expenses are things that you have to spend your money on routinely.
Excellent. That's perfect. Expenses are things that you spend your money on. So your rent, groceries, gym membership. Those are fixed expenses. They happen every month on a schedule. Now there's also variable expenses. My car broke down, or
I had an accident.
Yeah. So those are variable expenses that can't really be predicted. The next word, are you ready?
Yes.
Income.
I'd say income is any amount of money that goes into your pocket at any time.
That would be correct. Income is money that comes in. It's pretty simple, right? So now we're on to the 6th term. Now it's going to start to get a little bit more challenging. The first few are kind of easy, especially after number 10. It's going to get pretty difficult.
So I shouldn't get cocky, is what you're saying.
Yeah, basically, you're 5 for 5, I would say. But yeah, we'll see how we go. Number 6, I think you know what this one is, ROI. So what does ROI stand for, first of all?
ROI is return on investment. Return on investment is in relation to how much money was put into the investment, what money comes back. So like what kind of profit you're getting.
Yeah. To keep it simple, return on investment is you put a certain amount into, let's say, a house or a stock. However much money you get from selling that or in holding that is your return on investment.
So is that right?
I will give it to you. Ding, ding, ding. 6 for 6. Let's go to number 7. This one's difficult. A lot of people have heard this, but they have no idea what the definition actually is. Net worth.
I think maybe you might have taught me this.
Okay.
Your net worth is when you do like the sum of your debt, your assets, your liabilities, how much money you are, like whether it's over or under 0.
Yeah, more or less. She's got it right. And I want to just correct you with debts and liabilities. Debts are liabilities.
Did I say both?
You said both. Yeah, you said your debts, assets, and liabilities, those three things.
So just your assets and your liabilities.
Ding, ding, ding. So your net worth equals however many assets you have minus however many liabilities you have. Whatever that equals, whether it's negative or positive, is your net worth. So let's say you have $10,000 in your savings account. That's your $10,000 worth of assets. And let's say you've got $15,000 in student loan debt. So 10,000 minus 15,000, you have a net worth of negative 5,000. And this is pretty common in your early 20s for us millennials to have a negative net worth. Keep watching this channel because obviously I'm going to show you how to make it a positive net worth. All right, next one.
And also how to calculate your net worth.
Yeah, what about it?
I mean, I'm interested in knowing how to do that.
Oh yeah, we just did it. It was so simple. It was like, bing, bada bing, bada boom.
But what about my assets? I got assets.
Yeah, you just got to know what is an asset. So we got to be able to count all of those things. Count all your assets and put them together. It's pretty simple. Jimena, we're gonna get to know you a little bit more. Are you from the United States?
No, I grew up in the United States, but I am not a U.S. citizen. I am a Colombian citizen.
Okay, so these next few ones are pretty much exclusive to people in the United States, but let's see how your knowledge is hanging out with me all the time. 401k.
A 401k is a fund that you put money into, usually through your job for maybe retirement.
Ding, ding, ding. It is a retirement fund, usually through your job. And what about a match?
That would be where your job would see what you put in and match it.
Usually up to a certain extent, your job has a match. Or a company match is free money that your company is going to give you to encourage you to save for retirement. If you don't participate in the 401k, you're basically leaving free money on the table. Number 9 and 10, I'm gonna put together a Roth IRA and a traditional IRA. What are they and what's the difference?
Okay, they're both retirement funds. And then one, I'm gonna assume a Roth IRA. Oh, this is such a guess. A Roth IRA, maybe the investments go in different places. So in one, they'll go towards like stocks, and then the other one, they'll go somewhere else.
All right, so we have Jimena's first wrong answer. All right, she's gone 8 for 8 so far. Congratulations, that's pretty good. And actually, I'll give you a half a point for this one, so you're 9 out of 10. Because she is correct, a Roth IRA and a traditional IRA are both retirement accounts. But the difference between them isn't what goes in them, it's how they're tax advantaged or when they get taxed. A Roth IRA, you get taxed now. But in 2050, when I'm able to retire and take the money out, I get to take all the money that's in there out and don't pay a dime in taxes. Traditional IRA, on the other hand, I can put all that money in tax-free right now. But when I get older in 30 years and I want to pull it out, I'm taxed on that as a part of my income. The next one is interest. What is interest?
Oh, this one is hard. It's the amount of profit that the person or entity that lent you money is going to get on the money that they lent you.
Let's say I loan someone money or someone loans me money, and that would be the principal, however much money they loaned you. And interest is how much over time, how much money I'm gonna get back until the whole amount is paid off. Okay, that's kind of like the simple definition. Now, there's 2 different types of interest that we all need to know about, and one is simple interest and one is compound interest. APR. So what does APR stand for, and what is it associated with? What does it mean?
Yeah.
All right. So APR is annual percentage rate, which is basically something you'll see on all the credit cards that you take out or loans that you take out. Yeah, so the APR is how much interest you're going to pay every year. Annual, percentage rate. Annual is year, percentage is your percent, and that's your rate.
Okay.
Dividend.
I think these dividends only are related to stocks. And it is a little bit of money that the business that you invest in, that you buy stocks from, gives every stock owner periodically. And it's not always a given. Some businesses do it and some don't.
Ding, ding, ding. More or less, that is correct. A dividend is just money that a company pays you for holding a share in their company. And it usually comes from profits. Usually. It doesn't always. And like she said, not all companies pay a dividend. Next one, DRIP or DRIP. You gotta know these things, people.
I have no idea. I've never even heard that before.
So DRIP is just a dividend reinvestment program. Pretty sure that's what it stands for. So now that you know what DRIP stands for, what do you think it means?
So that would be when you don't cash out your dividends, but they get reinvested into the same stocks.
She's right again. Instead of taking 10 cents or 30 cents that Pepsi pays out for the quarter, you can just buy more Pepsi stock with that 30 cents, which equals fractional ownership.
Which would then help you with your compounding interest.
Which would then basically snowball and compound how much money, because the next time, instead of owning one share of Pepsi stock, next time you're going to own 1.1 share, which means you're going to get more than 30 cents on it. You're going to get 32 cents, and then next time 35 cents, and then it just like rolls and gets bigger and bigger. So yes, it compounds. The next financial literacy term that a beginner needs to know is, and we've already discussed this a little bit, but what is a stock or a share?
It's a little piece of a business that you can invest in to help them grow or develop, etc.
Index fund. What is an index fund?
So an index fund is a fund of stocks managed by AI or some sort of technology that isn't a human.
Very good. She's been hanging out with me too much. All right, so index funds are basically the same as a mutual fund, which a mutual fund is a basket of stocks is the best way to represent it. So Apple, Amazon, Pepsi, Tesla, all into one basket. Instead of you buying each individual, they've put together some good stocks. So real estate investment trust, REIT. What is it?
It is kind of like a stock, but instead of owning a piece of a business, you own a piece of real estate.
Wow, you're really good at this. So most of us can't afford to buy a lot of commercial property or a nursing facility or an apartment building. So REITs are a collection of people or a collection of shareholders who purchase these things. And the good thing about these REITs is they have to pay out 90% of their profits in the form of dividends, which means they pay really high dividends. And it's a good way to replace your income. Number 18. Opportunity cost.
I mean, I feel like I know the overall concept, but I don't really know how to define it.
Basically, doing something now in the present that forgoes the other things that you could have done. Let's say I decide to buy a rental property and I'm gonna put $20,000 down on this $100,000 rental property. I could have taken that $20,000 and I could have started a coffee shop, or I could have taken that $20,000 and I could have invested it into the stock market. But instead, I'm going to buy a house. The opportunity cost is the cost of $20,000 in stocks and the cost of starting my own coffee shop, because now I can't do that.
Right.
And you have to decide which one is the best thing for you to do based on, okay, what's the ROI gonna be? Credit score.
Your credit score is a number, like a grade kind of thing, right? That the credit gods give you a score depending on your good behavior with credit. So how often you pay your shit back on time. Can I say shit?
Yes. Yeah.
How often you pay your shit back on time, how long it takes you to pay it back, I don't know, things like that will add or take from your credit score. And if you don't take credit out at all, it's bad.
Very good. High five. All right. Basically, it's your report card as an adult to your creditors. And the lower your credit score is, the riskier of an investment that they see you as. And so the riskier you are, the higher return they want on their investment. So if you've got a low credit score, you're probably going to end up paying higher interest rates on everything, whether it be a new iPhone, a new car, or a new place for you and your family to live. So credit score is super important to track it and do whatever you can to keep it high and healthy and good. Great job. Number 20, let's see if you get a B or an A. I think we're already at B territory, but that's still really good. A high yield savings account.
Okay, so a high yield savings account is a savings account that gives you a higher interest rate on keeping your money there, but I don't know why.
I believe the real reason why they give you a higher rate is because they spend a lot less money on advertising, because most of the high yield savings accounts that you're going to find are actually online. And also because they're online, they don't have brick and mortar stores, so they're able to give you a higher interest rate than your traditional banks. So I do recommend you, if you don't already have a high yield savings account, open one up. I want to say thank you for your time, Jimena. It's been an absolute pleasure, and you did really good. I think you did, we're going to tally this all up at the end, but I think you did 16 or 17 out of 20, which means you're doing really good for a beginner. You're well on your way to becoming a rich mother lover. Yeah. All right, cool. Well, I hope you guys enjoyed it. Let me know what you scored down in the comments below, and make sure to share this with your friends. Have a competition. See who knows more about what's really going on in your pocketbook. I'll see y'all next time. Pocketbook.
I don't know, right?
Wallet. Love ya. Ciao.